Roelof, you're positive on bonds, you're negative on equities, and your caution, which we've talked about before, is reflected in a lot of the investor community. I mean, if you take a look at the State Street Global Markets Monthly Index, investors actually more cautious on equities than back during the financial crisis. I guess the way to look at this is a lot of money being on the sidelines waiting to be put to work. Yeah. So what would make you want to participate in that upside?
What would change our mind is basically if there's stabilization in your manufacturing sector, which there is not, if there's stabilization in services, that you don't see the slowdown in manufacturing spreading to services, which we are currently seeing. And what we don't want to see, to turn positive, you don't want to see corporations to continue to make people work less hours and eventually lay off people. And I think that's the risk, and that's the next step in what is normally a late cycle phenomenon.
So do you see the layoffs coming? Do you see problems and this is a question we're asking not just in the U.S., really, but everywhere because of the trade war. Do you see the manufacturing issues starting to hit the employment numbers?
We're seeing the first initial signs of that happening in Germany, in the auto sector, which is clearly the biggest hit sector for now. And we expect that to happen in other sectors as well, as you see the slowdown spreading and you see margins under pressure. Just look at what small companies in the US, the margins are under pressure, their hiring intentions are slowing, their capex intentions are slowing. So the next step obviously would be a reduction in the labor force, which is the normal logical step in a slowdown. If that happens, then you bring the recession call further towards the early part of 2020 and not the later part of 2020.
So is the bond market pricing the trade war risks and the impact on global growth correctly?
The bond market is always a bit earlier than the equity market in picking up the economic signals. So I think the bond market is spot on. The bond market is saying that growth is slow. The bond market is saying that inflation is low. And the short end of the yield curve is telling the Fed to lower interest rates by more than they are currently saying.
Where do you see the 10-year yield? We saw it bump back up again yesterday to 1.74%, and this is probably more of a Q issue than a trade issue, but where do you see the 10-year yield going near the end of the year?
The odds are that they go lower for our clients. We've allocated a bit more to US Treasury. That's also because US Treasuries are effectively higher yielding than German bonds, so you don't have a lot of risk there. And I think as long as we see growth momentum slowing and the Fed needing to do more, you don't have a big risk of yields backing up to beyond 2%. So we're okay there.
Does everything you've said, apart from maybe the Fed needing to do more, translate to dollar strength continuing?
I think the odds are for dollar strength, yes.